Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is June 9th, Friday, June 9th, 2023. It is now 12:51 p.m. Central Time, and today has been a real fight in the mortgage-backed security world. We started off pretty rough, down about 30 basis points, and have been climbing our way back, got back up into the single digits, and been just climbing slowly through those single digits. We did have a couple of intraday reprices from some of our banks. So started out with interest rates worse, and then through the day, as they saw the markets getting better, they pushed the interest rates down a little bit, gave us a little bit of room because the markets were improving. Now, if you watch this show often, you know that Fridays there's usually a pullback. So usually I say the banks like to take some chips off the table because they don't know what's going to happen over the weekend. They don't know if there's going to have some geopolitical issue, bank crisis, or anything else that would cause the bond market to shift during a time that they're not able to easily trade. So they take some of the money off the table just to wait to see what the weekend brings and then get that money back into the market on Monday. Let's take a look and see where we are right now. Okay, so right now, again, we're down 3 basis points. You can see over here in the green numbers, we have had to climb back from down over 30 earlier today to where now we're down by 3. 10-year Treasury is up still by 2. We don't want that to go up, but 2 basis points isn't too bad. You can see over here on the charts, kind of bouncing around in the range that we have been, still living on this Fibonacci level here before we start to fight with that 25-day moving average that is above us. And again, remembering that next week we have the producer price index report coming out, the consumer price index report coming out, and we're going to get the 2-day meeting by the Federal Reserve, including their announcement to what they're going to do with the federal funds rate. Now, again, the consensus is that the federal funds rate is going to stay the same. They're not going to increase it. They're not going to reduce it, calling that a pause. Pause being a very neutral term that allows them to come back and raise rates if they want to, or drop rates if they want to, without having to go back on their word. So if they say we're stopping and then they increase it, the markets will lose their mind because it will show that they don't know what is going on. So we're expecting a pause here this Wednesday. A lot going on next week that will hopefully really start to move us, in the direction that we want, seeing the effects of inflation. Now, here's something about inflation that I wanted to point out just quickly here before I show the interest rates. We've been talking about inflation being somewhat stubborn. Okay, somewhat stubborn, especially the last consumer price index and producer or produce, personal consumption expenditures reports coming out showing hotter than normal sales, or hotter than expected sales, especially in used auto sales, and overall costs of housing, so rents and housing expenses, staying stubbornly high. Now, housing is understandable because it's such a trailing indicator. It takes a while before housing starts to drift down. It is, but it's not drifting down as quickly as the Fed would like to see it. Now, used auto sales, strangely enough, was stubbornly high. So we're kind of curious as to why that is. However, the last reports that have come out are showing that used auto sales have come down tremendously over the last 2 months, and that should start to filter into the producer price index, the consumer price index and the personal consumption expenditures report here through the month of June. So let's take a look and see where we are. And I will show you another thing here that was interesting. Take a look here. Americans now owe nearly 1 trillion in credit card debt. And then it talks about the breakdown by age, and it says they now hold a record amount of credit card debt, the most credit card debt in the history of the United States. So when you talk about inflation being stubbornly high, meaning that people are continuing to spend, are they spending money they have, or are they spending money that they don't have because they want to maintain the quality of life that they're used to? Also want to maintain the quality of life that they sort of fell in love with when they were not only working, many people were not only working, but also getting stimulus checks, really giving them more income than maybe they've ever had before. So as that started to leave, started to go away, maintain the same quality of life, the same quality of expenses, and have to dip into the credit cards. Now, that also combined with the fact that we have had tremendous inflation, not inflation, we've had tremendous inflation to the point that your regular goods at the grocery stores, the gas stations, and basically anything else that you buy just costs more money. So that's why we start to see people going to their credit cards to bridge the gap. And that is now being clearly explained here, saying that we now have more credit card debt than we ever have in the history of the United States. And again, we know, we all know that there is a cap on credit cards. Number one, a cap to where we can't afford to make that minimum payment anymore. Number two, to where we say, look, I got to stop spending on my credit card. And number three, the fact that there is an actual credit limit. So if you just go ahead and keep going nuts, eventually they're going to say you don't have any more money on this credit card. So there is an end to credit card debt, and we don't want that to be what is keeping our economy going. So where are we as far as our interest rates right now? Again, we've had a couple of intraday reprices here today. So let's go ahead and see where we are at this moment. Again, yesterday, I think we were at 6.875 with no points. We're currently at 6.875 with a credit of 400, almost identical to where we were yesterday with the Lone Star here. However, you see that they're in an expired status, and that is because they are doing an intraday reprice as we speak. They're going in and changing their interest rates, which they're going to bring it down. So I would assume that this 587 cost is going to go away, and that once their new rate sheets come out, 6.75% will be available with no points. So I can basically assume that that is going to be the case. 6.0% is costing 1.977. That'll probably drop down to about 1.78 would be my estimation of where they would be once this intraday reprice occurs. Let's jump into United Wholesale. Again, 6.875 is at a little bit of a cost, 6.999. A little bit of a credit there, $443, and 5.999 is costing 1.855. So still almost 2 points to get to that 5.999 that we talked about. Here are the parameters for the scenario that we're looking at. Make sure that you like, subscribe, share, and hit the notification bell in the top corner if you are enjoying this information and if it is helpful. Have a great weekend. We will talk tomorrow and during our very busy week coming up.